There is a movement happening right now that could reshape the global financial balance, and almost no one is looking at it the right way. While headlines focus on U.S. inflation, Federal Reserve decisions, and stock market volatility, a silent mechanism is beginning to turn beneath the surface. It's not an official announcement. It's not a dramatic launch of a new currency. It's something far more strategic, deeper, and potentially more disruptive to the current structure. BRICS is building alternatives, not through ideological speeches, not through impulsive declarations, but through real infrastructure, bilateral agreements, parallel payment systems, trade settlement outside the dollar, coordination between central banks, and when infrastructure changes, power shifts with it. For more than 7 decades, the international financial system has had a clear center. After World War II, the Bretton Woods Agreement placed the U.S. dollar at the core of the global architecture. Even after the end of the gold standard, the dollar remained dominant. International trade became largely priced in dollars. Global reserves were accumulated in dollars. Sovereign debt was issued in dollars. Financial messaging systems like SWIFT reinforced this centrality. The world began operating as a vast network connected to a single core. And that core offered 3 essential elements: deep liquidity, predictability, and institutional trust. It was efficient, stable, convenient. But it also created dependency. When 2 countries trade with each other, even if neither is the United States, the transaction often passes through the dollar. An Indian company buys energy from the Middle East. Settlement in dollars. A Brazilian exporter sells commodities to Asia. Pricing referenced in dollars. An African nation finances infrastructure. Loans structured in dollars. The dollar is not just America's currency. It became the universal language of global transactions. And language is power. Whoever controls the dominant currency influences global capital flows. They can impose sanctions, restrict access to international banking systems, freeze assets, use the financial system as a geopolitical instrument. For a long time, this structure was viewed as natural, untouchable, permanent. But recent events changed that perception. When countries began to be excluded from the Western financial system due to political decisions, a signal was sent to the rest of the world. Access can be conditional. And when access can be conditioned, dependency becomes a strategic risk. This is where the BRICS movement gains depth. Originally formed as an economic grouping of emerging nations, the bloc began discussing something much larger than trade. It began discussing monetary autonomy. This is no longer just about growth. It's about financial sovereignty. After facing severe sanctions and partial exclusion from the global financial system, Russia accelerated bilateral agreements outside the dollar. China expanded yuan-based trade with strategic partners. India structured settlements in local currencies. Brazil initiated discussions about bilateral clearing mechanisms. The new development bank strengthened its role as an alternative financing institution. None of these actions alone dismantle the current system. But together, they begin to outline a parallel architecture. While blocs like BRICS discuss alternatives to the dollar, internal and external pressures are accumulating within the current system itself. U.S. public debt continues to grow at an accelerated pace. Fiscal deficits expand. Financing costs rise as interest rates increase. At the same time, the growing use of financial sanctions generates discomfort among nations seeking to reduce vulnerabilities. What BRICS appears to be doing is not launching a frontal attack on the dollar. It is creating options, and options reduce dependency. If trade among member countries increasingly settles in local currencies, the structural need for dollars gradually decreases. If central banks diversify reserves, concentration in U.S. treasuries may slowly decline. If alternative payment systems gain scale, monopoly communication channels weaken. This is not revolution. It is slow erosion. But every structural transformation begins this way. The real question is not whether the dollar will collapse. That's a simplistic framing. The deeper question is, are we entering a transition toward a multipolar monetary system? In a multipolar system, there is no single dominant center. There are multiple poles of influence, different currencies with regional strength, various payment infrastructures, multiple liquidity hubs. This may reduce concentration of power, but it increases complexity, and complex systems are harder to stabilize during crises. The dollar became dominant because it offered market depth and legal certainty. The U.S. Treasury market remains the deepest and most liquid in the world. Global investors trust American institutional predictability. This creates a reinforcing cycle. The more the dollar is used, the stronger it becomes. Breaking that cycle requires more than political intent. It requires scale, and scale requires time. BRICS faces significant internal challenges, political differences, economic asymmetries, diverging strategic interests. Creating a unified currency would demand fiscal integration and coordination that currently do not exist, which is why the objective may not be a single shared currency, but a flexible network of agreements that reduce dependency without requiring full monetary union, a hybrid system. This model may include bilateral trade in local currencies, a possible unit of account based on a basket of currencies or commodities, expanded central bank swap lines, and strengthened alternative financial institutions. If this gains traction, the impact will be gradual, but meaningful. Global demand for dollars could marginally decline in specific trade flows. International reserves could slowly diversify. Debt issuance could reference multiple anchors. None of this generates explosive headlines in the short term, but markets price the future. If investors begin to factor in a world with reduced dollar centrality, adjustments may occur in financing costs, reserve composition, and currency dynamics. The real risk is not sudden collapse, it is transition, and transitions are historically volatile periods. The British pound did not lose dominance overnight. The process unfolded over decades, shaped by wars, fiscal strain, and shifting economic power. The transition was gradual until it wasn't. Today, we may not be witnessing outright replacement, but we may be witnessing redistribution of influence, redistribution of capital flows, redistribution of monetary power. This has direct implications for governments, central banks, and investors. Reduced dollar centrality could mean higher long-term financing costs for the United States if structural demand for treasuries declines. It could lead to greater currency volatility between blocs. It could intensify competition for global trust. At the same time, building alternatives does not automatically guarantee stability. A fragmented system may face coordination challenges. During global crises, multiple centers could complicate synchronized responses. The central issue is not whether the dollar will disappear. That scenario remains unlikely in the near future. The real issue is whether its absolute dominance may become relative. And relative dominance changes the balance of power. If the world begins operating with 2 or 3 major financial poles, monetary policy decisions in one country may carry less concentrated global influence. The authority of any single center may diminish. That reshapes geopolitical strategy. BRICS may not be preparing an immediate rupture, but it is signaling something important, the desire for alternatives. And when major economies desire alternatives, they invest in infrastructure. Infrastructure creates possibility. Possibility creates choice. And choice alters negotiation dynamics. Perhaps the most significant shift is not the creation of a new currency, but the construction of a network that allows countries to choose when and how to use the dollar. That alone changes incentives. If dependency ceases to be mandatory and becomes optional, the center loses part of its structural strength. It is still early. The dollar remains dominant. The U.S. market remains deep. Institutional trust remains strong, but ignoring the movement would be a mistake. Because structural shifts rarely announce themselves loudly. They accumulate, they strengthen, and when they finally become visible, they are often already advanced. We may be witnessing the beginning of a new phase in global financial architecture, not an explosion, but a silent redistribution. The question is not whether BRICS will replace the current system tomorrow. The question is whether we are entering a decade of transition, where multiple financial poles begin to share influence. And if that happens, who will be prepared? Governments will need to adjust reserve strategies. Multinational corporations will need to manage currency risk across multiple centers. Investors will need to understand geopolitical capital flows at a deeper level. The international monetary system has always reflected the global balance of power. If that balance is becoming more distributed, the monetary system will eventually reflect it. BRICS may not be declaring revolution, but it is building alternatives, and alternatives, once large enough, do not need to destroy the center to transform it. They only need to reduce its centrality. And reducing centrality is already a historic shift. What we may be witnessing is just the beginning. And those who understand structural movements know the biggest transformations start when almost no one is paying attention. Now the question is simple and strategic. Will you ignore this shift or start watching how it could redefine the next chapter of the global financial system?